What's up, viewers? Welcome to the channel. In today's episode, I want to share my experience with a simple put contract that I entered into earlier this week and give you an analysis of the potential returns that I expect from this transaction. We're going to be covering ticker symbol ARDX. ARDX is a biopharmaceutical company. They're currently trading today, 11th of November, at $1.27. But we sold the put contract at the $1 mark and received quite a significant premium payment. And that's what we're going to talk about today. All right, let's get it. If we take a look at the charts for ARDX, what you will notice is that it was trending above the $7 mark in 2021, and somewhere around July 2021, there was a sharp drop from the $7 mark to just about the $2 mark. And then it started to trend down below the $1 mark. But right now, it seems to be trending back up, and it's crossed the $1 mark. And if we zoom in, what you will realize is it has been trading above the $1 mark since September 2022. And so it seems to hit the $1.5 mark range and then comes back down to the $1.1 mark range. And then it goes back up and it comes back down. It might go back down, and it is possible that it might go back up as well. But it's fair to say that we can take a chance on it not hitting the $1 mark in the next 10 days, starting from when the contract was executed. If we take a look at the Tastyworks account, what we did was on the 8th of November 2022, we sold a total number of 24 put contracts. As you can see here, they're all executed at different time slots because of the availability in the market. But suffice to say, we sold a total of 24 put contracts at the $1 strike price. And in total, we received about $266 in paid premium. Of course, there were fees, but we will now look at the analysis of the net proceeds from this transaction and what could happen if we get assigned compared to if we don't get assigned. As mentioned at the beginning of this video, we will only get assigned on this put contract if the price of ARDX falls below the $1 mark. Right now, based on historical figures, ARDX is not trending anywhere close to the $1 mark. So there's a high probability that at the expiration of this contract on the 18th of November 2022, the price of ARDX will still be above the $1 mark. And what this means is that the contract will expire worthless and we get to pocket the premium that has been paid to us. The flip side of that coin is that something drastic happens between now and the 18th of November 2022, and the price of ARDX does fall below the $1 mark. What that means is that we get assigned and we have to buy ARDX at the put strike price, which is $1. Now, that is also not a bad position to be in, given that the lowest that ARDX has fallen is the 50-cent mark. And if you look at the third quarter earnings expectations for ARDX, they're looking to narrow their losses. Their business is growing in leaps and bounds. So the expectation is that even though the price of ARDX has dropped, it is time for it to go up. And the analysts put a fair value of ARDX way above the $1 mark. So this is not a bad stock to own at that $1 price point. And we will demonstrate that in the analysis coming up. Okay, let's take a look at the analysis for the two possible scenarios on the put contract that we've executed for ARDX. As mentioned, we executed the contract on the 8th of November 2022. The contract should expire on the 18th of November 2022. This means this is a 10-day contract. We said we sold 24 put contracts at the $1 strike price, which means we have reserved $2,400 in our account in the event that we get assigned. And for selling those contracts and committing to buy ARDX at the $1 strike price, we received a premium of $266. Fees charged for this transaction totaled $2.97. And that means that we received a net premium of $263.06. Now, when you compare the $263.06 to the capital allocated for this transaction, which is $2,400, the return on capital deployed is just shy of 11%. When you annualize this, you're looking at a 400% return on an annualized basis. What that means is if you're able to achieve just under 11% every 10 days on your investment amount will be up 400% by the end of a 1 year period. What is the story if we get assigned? If we get assigned, the net cost will be the 2,400 that we put down less the 263.03 that we received. And this translates into a net cost of 2,136.97. This would translate into a $0.89 cost per share price. So even though the put is the $1 strike price, because of the premium that we've received, our actual cost will be 89 cents. That's an 11-cent discount on the cost that we actually paid out. Again, this is not a bad price to pay for a stock that analysts have deemed to have a fair price of way above the $1 mark. So either way, we will win on this transaction. We hope you enjoyed that video. If you haven't done so already, please hit that subscribe button and the notification bell so you get to see new content that is uploaded to this channel as soon as it goes live. And if you've got a question, please leave your question in the comment section. You can also do us a favor by sharing this video on your social media feed. There's somebody out there on your network that deserves to be informed about such opportunities. So do them a favor and do us a favor as well by hitting that like button so that the YouTube algorithm will get the word out about this content. You can also check us out on Twitter and Instagram on those handles mentioned below. Thanks for watching.